Okay, let's unpack this. You know, have you ever thought about that small bank account maybe you left open years ago when you lived overseas?
Right, or maybe you're thinking about inheriting something from a relative in another country.
Exactly. Or even just getting a big gift from someone here in the US. You might just assume it's, well, straightforward.
Yeah, maybe it's not U.S. income, or you
Yeah.
think, it's too small to matter.
But the US has these layers, really, of incredibly complex rules about foreign money, foreign assets.
And also about how wealth transfers, through gifts or when someone passes away, estates.
It's a world I think many people just stumble into without realizing they have these, well, significant obligations.
And it can feel overwhelming, definitely, because the rules aren't all neatly in one place. You've got reporting just for having foreign assets,
Yeah.
then completely separate rules for getting large gifts, and then a whole other system for, estates and inheritances.
Our sources cover all of this, and yeah, it's a lot.
It is.
So, welcome to a deep dive into this often confusing landscape: U.S. foreign financial reporting and U.S. estate and gift taxes, all based on the sources you've shared with us.
And our mission here really is to try and cut through that noise. We want to pull out the most important stuff, the key triggers, the forms you really need to know about.
And explain why these rules exist, right? It seems like it's mostly about transparency, tracking wealth.
Primarily, yes, transparency and tracking. And we want to point out those unexpected details, the things that can easily trip people up.
Turn this big stack of information into something clear, something actionable.
That's the goal. Clear, actionable understanding.
And we're here to guide you through it, point out the crucial bits, help you see how these different pieces actually connect.
Oh, that's good.
So let's start with that first area, U.S. foreign financial reporting.
Okay. This whole area really started gaining momentum, well, decades ago, largely with the Bank Secrecy Act, the BSA, back in 1970.
Okay, 1970, that was aimed at money laundering.
Yes, exactly. Fighting money laundering, tracking funds. And that's the foundation for the FBA report we'll talk about.
And more recently, there's FATCA.
Yes, FATCA, the Foreign Account Tax Compliance Act. That added more requirements for reporting specific types of foreign financial assets.
So the key takeaway here is these aren't just minor suggestions, they're serious compliance rules.
Very serious. Designed to give the U.S. government visibility into money held outside the country.
And it sounds like the rules apply pretty broadly. I mean, who counts as a U.S. person for this?
It's a wide net, really. For these foreign reporting rules, a U.S. person includes U.S. citizens, obviously U.S. nationals, U.S. residents.
So green card holders.
Yes, and U.S. entities like corporations or partnerships. It also, interestingly, covers non-resident aliens if they've made a specific election to be treated as a U.S. resident for filing a joint tax return.
Wow, okay. So even if you haven't lived stateside in years, if you're a U.S. citizen, these rules could still absolutely apply to you.
Correct. Citizenship is key.
And it's not just one form, is it? The sources mention a few different ones.
No, definitely not just one. And that's where it gets confusing because different situations, different assets trigger different forms. The big ones we need to look at are the FBIR, that's officially FinCEN Form 114.
Okay.
Then there's Form 8938, the Statement of Specified Foreign Financial Assets.
Right.
There's also a specific question on Schedule B, Part 3 of your regular income tax return.
Ah, the yes-no box.
That's the one. And Form 3520 for foreign gifts and trusts. And Form 5471, which deals with foreign corporations.
And a really crucial point you mentioned right at the start for some of these, like FBAR, maybe 5471.
Yes.
The reporting obligation exists even if the foreign account, or say the foreign company, doesn't make you any money, no income generated.
Absolutely. Critical point. Yes.
Yeah.
And even if your overall income is so low, you don't normally have to file a U.S. income tax return.
So it's the having it, not the earning from it, that triggers the form.
Precisely. It's the mere existence of that foreign connection or asset that triggers the reporting requirement. It's separate from whether it produces income or whether you meet the income threshold for filing a Form 1040.
All right, that's huge. Let's dive into the one people probably hear about most often then, the FBAR, Form 114.
Okay, FBAR, Report of Foreign Bank and Financial Accounts. The absolute most important thing to grasp about the FBAR is that it is purely a reporting requirement. Information only.
So you don't pay tax with the FBR.
No, you don't pay tax on the FBAR itself. It's simply about telling the government, specifically the Treasury Department, hey, I have financial accounts outside the U.S.
But it's the IRS that enforces it.
Yes, exactly. Even though it's technically a Treasury form filed with FinCEN, The IRS was delegated the authority back in 2003 to enforce it, investigate violations, assess penalties, issue rulings, all of that.
Okay. And what's the trigger? What makes you actually have to file an FBAR, that key threshold?
This is the one that catches so many people. The threshold is you need to file if you have a financial interest in or signature authority over at least one financial account located outside the United States.
Okay.
And the aggregate value of all your foreign financial accounts combined exceeded $10,000 at any time during the calendar year.
Wait, hold on. So add up all the accounts.
Yes, all of them. Checking, savings, brokerage, mutual funds held abroad.
And just over $10,000 total across all of them combined for even one day.
Exactly. If on any single day of that year, the sum of the maximum values reached in each of your foreign accounts hit, say, $10,001, you have an FBAR filing requirement for that entire year.
Wow. That is a very low threshold. And it's the same for everyone, single, married.
Same $10,000 aggregate threshold regardless of filing status.
And unlike, say, your Form 1040, you don't actually mail this in with your tax return.
Correct. Big difference. You file the FBAR electronically and separately directly with FinCEN, Financial Crimes Enforcement Network. It's another bureau within the U.S. Treasury Department.
Yeah.
So not filed with the IRS, though again, the IRS enforces it.
Okay, got it. Filed separately, electronically, with FinCEN. Now, here's a really unexpected detail the sources bring up. There's no age limit.
That's a detail that truly surprises people. Yes,
Yeah.
no age limit. If a minor child, technically meets that $10,000 aggregate threshold, maybe from an account set up by grandparents overseas, that child is technically required to file their own FBAR. Even if they have zero income, no other reason to interact with the U.S. tax system.
So a kid needs to file. How does that even work?
Well, if they're too young or unable to file it themselves, a parent or legal guardian must file it for them and sign it on their behalf.
Wow, that is a significant responsibility many parents could easily overlook, I imagine.
Absolutely.
What about the deadline for FBAR?
The official due date is April 15th, same as tax day, covering the previous calendar year. So the FBAR for 2024 is due April 15th, 2025.
But there's an extension.
Yes, and this is good news. FinCEN grants an automatic extension for everyone to October 15th. You don't have to file a form or request it. It just happens.
So automatically extended to October 15th. That's helpful.
It is.
But we shouldn't assume that FBAR deadlines automatically follow IRS tax deadline extensions, like for natural disasters or something.
No, that's another potential pitfall. Definitely do not assume that. While the IRS might push back income tax deadlines in certain situations, FBAR deadlines generally stick to that April 15th, October 15th schedule. Extensions beyond October 15th are very rare for FBAR.
Good to know. And just to reiterate, whether the account actually earns any income, interest, whatever, that doesn't matter for the FBAR filing.
Completely irrelevant. Filing is based purely on the existence and the $10,000 aggregate value threshold.
Okay. What about spouses? Joint accounts. Can one spouse just file for both?
Generally, yes, but there are specific conditions. Spouses can avoid filing separate FBARs if, and this is important, if all the reportable accounts the non-filing spouse has an interest in are jointly owned with the filing spouse. And the filing spouse reports all those jointly owned accounts on their timely filed FBAR.
So if they meet those conditions, what does the non-filing spouse do?
They just need to complete and sign a Form 114A, which is an authorization for the electronic filing. They keep that form for their records. They don't actually submit it to FinCEN.
But what if, say, one spouse has their own separate foreign account, maybe from before they were married?
In that case, they both generally need to file separate FBO.
And on those separate FBARs, they'd each report the joint accounts too.
Precisely. Each spouse would report the full value of any joint accounts on their own separate FBAR, in addition to any accounts they own individually.
Got it. And record keeping, how long should you hang on to this stuff?
You need to keep records that support your FBAR filing for 5 years from the FBAR due date. That includes things like account statements showing the maximum value, account numbers, names of the institutions, etc.
Okay, 5 years. Now, let's talk about why this matters so much. The penalties. The sources really emphasize this. Millions are filing now, but the consequences for not filing, they sound really serious.
This is where that low $10,000 threshold meets potentially, devastating penalties. It's not an exaggeration. For a non-willful failure to file, meaning you genuinely didn't know or you weren't trying to hide anything.
Just an oversight.
Yes, an oversight. Even then, the civil penalty can exceed $10,000 per year that you failed to file. and that amount is adjusted for inflation, so it creeps up.
Per year. So if I just forgot about a $12,000 account for, say, 3 years, that could be over $30,000 in penalties, even if it was an honest mistake.
That's the potential exposure, yes, for
Yeah.
non-willful violations.
Wow. Okay, and what about willful failure, where the government thinks you knew better or maybe reckless?
That's where it gets truly severe. The civil penalty for a willful failure is the greater of $100,000, or 50%. 50% of the highest balance in the unreported foreign account during the year.
50% of the account balance as a penalty
Yes,
per year.
for up to 6 years back.
So wait, if you willfully didn't report an account for several years, the penalty could actually be more than the total amount of money in the account.
Absolutely. The sources point this out clearly. It can very quickly add up to exceed the account value itself.
And that's just the civil penalty.
That's just the civil side. On top of that, criminal penalties are possible for willful failure. We're talking fines up to $250,000 and potentially up to 5 years in prison, in addition to those massive civil penalties.
That is just staggering. I mean, a $12,000 account in a worst-case willful scenario could theoretically lead to hundreds of thousands in penalties over just a few years.
It's a risk that feels incredibly disproportionate to the asset value in many cases, for sure. But that's the law.
And failing to file at all is the most common mistake.
Seems to be, yes. And while the IRS does have some internal guidance that sometimes caps the maximum percentage penalties in certain non-prosecution scenarios, the clear message is the government is extremely serious about FBAR compliance.
No kidding. Okay, so what exactly counts as a foreign financial account for FBAR? Is it just bank accounts?
Generally, it's broader than just bank accounts. I think any financial account maintained outside the U.S. So brokerage accounts, securities accounts, mutual funds held directly abroad, even certain foreign insurance or annuity policies with a cash value can count.
Are there any specific exceptions, things that don't count?
Yes, there are some specific exclusions, like accounts owned by governmental entities or international financial institutions. Also, accounts maintained at a U.S. military banking facility, like a bank branch on a U.S. base overseas, those are generally excluded.
What about something like a safe deposit box in a foreign bank?
Good question. The safe deposit box itself isn't considered a financial account you report on the FBAR.
Okay.
But your T, and this is a really important nuance, if you are holding certain assets inside that safe deposit box and the box is located at a foreign financial institution, things like gold bullion, physical foreign currency, the value of those contents could potentially be subject to FBAR reporting if, when you add their value to your other foreign financial accounts, the total goes over that $10,000 threshold.
Interesting. So it's about the assets held within the institution, even if not in a traditional account.
It can be, yes. It's a tricky area.
Okay. Let's switch gears a bit, but still related to foreign money coming in. The sources talk about Form 3520. This is for foreign gifts.
Yes, Form 3520, annual return to report transactions with foreign trusts and receipt of certain foreign gifts. This comes into play if you're a U.S. person, an individual, usually, and you receive a large gift or maybe a bequest and inheritance from certain foreign persons.
What's the threshold for large here? How much triggers this form?
For gifts or bequests from a non-resident alien individual or a foreign estate, the threshold is receiving more than $100,000 in total during the calendar year.
Over $100,000. And does that aggregate too? Like if multiple foreign relatives give you money?
Yes, you do need to aggregate gifts or bequests received from related foreign parties when checking against that $100,000 threshold.
So if your aunt in France gives you $70,000 and your uncle in France gives you $40,000 in the same year, assuming they're related, that's $110,000 total, and boom, you need to file Form 3520.
That's exactly right. You'd cross the threshold.
And just like the FBAR, this Form 3520, it's an information return, right? You're not paying U.S. income tax on the gift itself.
Correct. Another information return. Generally speaking, gifts and bequests received by a U.S. person from a foreign person are not subject to U.S. income tax. So no tax is assessed on Form 3520 itself. You're just informing the IRS about the transaction.
Okay. And when is Form 3520 due?
It has the same due date as your individual income tax return, your Form 1040, so usually April 15th, and it gets extended if you extend your 1040. But importantly, you file Form 3520 separately from your 1040. Mail it to a different address.
Filed separately, same due date as the 1040. Are there any types of payments from foreign persons that don't count as reportable gifts on Form 3520?
Yes, the sources mention a key exception: payments made by a foreign person directly to an educational institution for your qualified tuition or directly to a medical provider for your qualified medical expenses. Those generally don't count towards the $100,000 threshold and don't need to be reported.
Ah, okay. Direct payments for tuition and medical are often treated differently. Good to know.
Yes.
So we have FBAR, Form 114, for foreign accounts over $10K aggregate, Form 3520 for large foreign gifts bequests over $100. Now, what about Form 8938, the Statement of Specified Foreign Financial Assets? How does that fit into the puzzle?
Okay, Form 8938. This is another layer added by the FTCA legislation we mentioned earlier. Yeah. If you hold what are called specified foreign financial assets and their value exceeds certain thresholds, you have to report them on Form 8938.
And this one is filed with your tax return?
Yes, this one gets attached to your Form 1040. And critically, this reporting requirement is in addition to FBAR, not instead of it. It's very common for someone to have to file both FBAR and Form 8938 for the same assets.
Okay, so potentially double reporting, just on different forms sent to different places. What counts as a specified foreign financial asset? Sounds maybe broader than just bank accounts.
It definitely is broader. The sources give examples. It includes the obvious things like accounts at foreign financial institutions, but also things like foreign stocks or securities if they're not held in an account at a U.S. brokerage firm. An interest you might have in a foreign estate, an interest in a foreign partnership, foreign pensions or foreign deferred compensation plans, even an interest in a foreign life insurance or annuity contract if it has cash value.
Wow, okay, that's a much wider net than just bank accounts. And the filing thresholds for Form 8938 are different from FBAR's $10K, right? And they vary.
Yeah, they're different, and they depend on whether you live inside the U.S. or outside the U.S., and also on your tax filing status. This is where it gets a little detailed.
Let's try to break it down for people living inside the U.S.
Okay, inside the U.S., if you're unmarried or married filing separately, MFS, you need to file Form 8938 if the total value of your specified foreign financial assets is more than $50,000 on the last day of the tax year, or if it was more than $75,000 at any time during the year.
$50,000 end of year, $75,000 anytime. What about married filing jointly, MFJ, in the U.S.?
For MFJ living in the U.S., the threshold's double. You file if the assets are worth more than $100,000 on the last day of the year, or more than $150,000 at any time during the year.
Okay, $150K for MFJ in the U.S. Now, what if you're a U.S. person living abroad?
If you live abroad, the thresholds are significantly higher, which makes sense. For unmarried or MFS taxpayers living abroad, you file if the assets exceed $200,000 on the last day of the year or $300,000 at any time during the year.
$300,000. And for married filing jointly living abroad?
Those thresholds double again, over $400,000 on the last day or over $600,000 at any time during the year.
Okay, $400K, $600, definitely much higher thresholds for expats. But here's a key difference from FBAR, right? The sources say if you don't have to file a regular income tax return anyway.
Yes, that's a crucial distinction. Unlike FBAR, Form 8938 is filed with your income tax return. So the general rule is, if you are not otherwise required to file a U.S. income tax return for the year, maybe your income is below the filing threshold, then you typically do not need to file Form 8938, even if the value of your foreign assets is above these thresholds we just discussed.
Ah, okay. So 8938 reporting is linked to having an income tax return filing obligation in the first place.
Generally, yes. That's a key difference from FBAR.
What about things like, say, foreign real estate? If I own a vacation home overseas, does that count towards these 8938 thresholds?
No, generally not. Direct ownership of foreign real estate is not considered a specified foreign financial asset for Form 8938 purposes. Now, if you have that real estate through a foreign entity, like a foreign corporation or partnership, then your interest in that entity might be reportable, but the directly held real estate itself is not.
What about other physical things? Art? Gold bars I keep overseas? My classic car stored in London?
Also generally excluded.
Yeah.
Directly held tangible assets like art, precious metals like gold bullion, if held directly, not in an account, jewelry, cars, collectibles, those are not specified foreign financial assets for Form 8938. Same for physical foreign currency you possess directly, like cash not held in a financial institution.
Got it. So 8938 focuses on financial accounts and certain financial instruments or interests held abroad, not so much physical stuff or direct real estate.
That's a good way to summarize it, yes.
Okay, let's touch quickly on Schedule B, Part 3. This sounds almost too simple, just a question on your regular tax return.
It is pretty simple on the surface. Schedule B, as you know, is primarily where you report U.S. source interest and dividend income. But way down in Part 3, there's a little section with questions about foreign accounts.
And one question asks,
It asks directly, at any time during the tax year, did you have a financial interest in or signature authority over a financial account in a foreign country? And there's just a yes or no box to check. It also asks about foreign trusts.
and the key takeaway here, the sources emphasize, is that there's no dollar threshold for checking yes on that box.
Exactly. This is another nuance that can easily trip people up. If you are filing a U.S. income tax return for any reason, maybe you have U.S. income requiring a return, and you had any kind of financial interest in or signature authority over a foreign financial account during the year, you must check the yes box on Schedule B, Part 3.
Even if the account had like $50 in it, way below the FDAR threshold.
Even if it had $50, even if you don't need to file an FBAR because you're under the $10,000 aggregate threshold,
Yeah.
if you're filing a 1040 and had any foreign account connection described, you check yes. There's no minimum dollar amount for this question.
But if your income is low enough that you don't have to file a 1040 at all, you don't need to file one just to check this box.
Correct. If you have no other reason to file an income tax return, you don't need to file one solely to answer this Schedule B question. But if you are filing, check it accurately.
Got it. Check yes, if filing anyway, and had any foreign account interest or authority. Okay, last one in this foreign section. Form 5471, Foreign Corporations.
Right. Form 5471, Information Return of U.S. Persons with respect to certain foreign corporations. This is generally for U.S. persons, individuals, or entities who have certain relationships with or ownership stakes in foreign corporations.
Like being an officer or director, or owning a chunk of stock.
Typically, yes. Being an officer or director or owning directly, indirectly, or constructively 10% or more of the stock by voter value often triggers a filing requirement. There are different categories of filers based on the specifics.
And it's usually filed with your income tax return.
Generally, yes, attached to the Form 1040 or other relevant U.S. tax return.
And similar to FBAR, the sources mention this requirement might apply even if the U.S. person doesn't meet the income threshold to file a regular tax return.
That's correct. Again, the filing requirement is triggered by your specific relationship or ownership percentage in the foreign corporation. It's not necessarily tied to your personal income level or whether you have a 1040 filing requirement or even whether the foreign corporation made any profit. It's an informational return based on that connection.
And the penalties for not filing a required 54471.
They are significant. The base penalty is $10,000 for each required Form 5471 that isn't filed timely or completely. And additional penalties can accrue if the failure continues after the IRS notifies you.
Okay, $10,000 per form per year. That adds up fast if you have multiple interests or miss multiple years.
It certainly can.
All right, that was a whirlwind tour of the main foreign reporting forms.
Right.
Let's recap quickly. FBAR, Form 114, for accounts over $10 aggregate filed separately with FinCEN. Form 8938 for specified foreign financial assets over higher thresholds filed with your tax return. The Schedule B, Part 3 checkbox, no threshold, just check yes if filing anyway and had any foreign account. Form 38520 for large foreign gifts or bequests over $100 K filed separately. And Form 5471 for certain interests in foreign corporations, usually filed with your tax return.
That covers the key ones from the sources.
And the big themes seem to be low thresholds can trigger reporting, obligations can exist even without income, they're often information returns but with very serious penalties for noncompliance. It's all about transparency for the U.S. government.
Exactly. Transparency is the driving force behind all these rules.
Okay, let's completely shift gears now, but keep with that theme of wealth and how it moves. Let's dive into the world of U.S. estate and gift taxes. You mentioned earlier these two taxes are often discussed together.
Yes, they're very closely linked, primarily because they share the same lifetime exemption amount. The gift tax applies to transfers of property you make while you're alive,
Okay.
and the estate tax applies to the transfer of your property after you pass away.
And neither of these is an income tax, right?
Correct. Very important distinction. They are transfer taxes, taxing the movement of wealth from one person or entity to another. The estate tax is sometimes called a death tax, but technically it's a tax on the transfer of assets from the deceased person's estate.
And when someone passes away, the law kind of creates a new legal entity, their estate.
That's exactly how the system views it, yes. When a person dies, their estate comes into existence as a separate legal entity. Its purpose is to hold the decedent's assets, pay their debts and taxes, and then distribute whatever is left according to their will or estate law.
And this estate, like a business, might need its own tax ID number.
Yes, the estate usually needs to obtain its own employer identification number, or EI, from the IRS. Our sources briefly mention bankruptcy estates use EINs too, but we're focused on the estates of deceased individuals here.
And managing this whole process often involves the court system through something called probate.
Yes, probate is generally the formal court-supervised process for administering an estate. It involves things like validating the will, if there is one, appointing someone to be in charge, notifying creditors, paying bills, and eventually approving the distribution of assets to the heirs or beneficiaries. The specifics vary quite a bit from state to state.
And the person put in charge of the estate, they have a specific title?
They do. They're generally referred to as the personal representative.
Oh.
If the deceased person had a valid will that names this person, they're typically called the executor, or executrix if female, though executor is common for all now.
Okay.
If there was no will or the named executor can't or won't serve, the probate court will appoint someone, and that person is usually called the administrator.
Executor with a will, administrator without one. But either way, they're the personal representative with legal authority.
Correct. They have the legal power and the responsibility to act on behalf of the estate. And just a side note, having a will is definitely recommended for many reasons, but it doesn't necessarily mean you avoid probate altogether. It just usually makes the probate process smoother and ensures your wishes are known.
And the IRS sometimes uses that term personal representative a bit more broadly.
In mind, yes. The sources mention the IRS sometimes uses it to refer to anyone who is acting on behalf of the deceased person, maybe for filing their final income tax return. But for more formal actions, like signing an estate tax return or dealing with estate tax matters, the IRS will want proof that you are the legally appointed executor or administrator.
How do you prove that to the IRS?
Usually you need to provide documentation, like a court certificate showing your appointment, or sometimes a copy of the will certified by the probate court. Just stating I'm the executor usually isn't sufficient for formal estate matters.
Okay. So what are the main jobs, the main duties of this executor or personal representative, especially regarding taxes?
Well, beyond the general administration tasks, their key responsibilities related to the IRS include obtaining that EIN for the estate, filing Form 56, notice concerning fiduciary relationship, to let the IRS know they are acting for the estate, managing the assets prudently, distributing assets according to the decedent's wishes or the law, and crucially for our discussion, making sure all required tax returns are filed correctly and any taxes owed by the decedent or the estate are paid.
And there could be several different tax returns involved, right? It's not just one.
That's right. There are potentially 3 main federal tax returns the executor might need to deal with.
Okay, what are they?
First, there's the decedent's final individual income tax return. That's Form 1040.
Covering income before death.
Exactly. Income the person received or was entitled to receive up until the date they died. Second, there's the estate's own income tax return. That's Form 1041.
And that covers income the estate earns after death.
Correct. Income generated by the estate's assets during the period of administration. And third, potentially there's the federal state tax return. That's Form 706.
Okay, 1040, 1041, 706. Let's break those down a bit. The decedent's final Form 1040. How does that work?
It's actually pretty straightforward. It's filed using the same Form 1040 the person would have used if they were alive. You just usually write deceased across the top, along with the decedent's name and the date of death.
And it covers income up to the date of death.
Yes, for the period from January 1st up to the date the person passed away. The filing deadline is the regular individual tax deadline, typically April 15th of the year after the person died.
Who signs it?
The executor or personal representative signs it, indicating their capacity. For example, John Doe, executor. If a joint return is being filed with a surviving spouse, the surviving spouse can also sign.
And the tax rules, deductions, credits, are they the same?
Generally, yes. The rules for income, deductions, and credits are the same as they would have been if the person were alive. One point the sources note: the year of death is not treated as a short tax year just because the person didn't live the full year. They still get their full standard deduction, for example.
Okay, so the final 1040 covers income before death. What about income the estate might earn after the person dies? Like if the estate holds rental property that keeps generating rent or stocks that pay dividends.
That's exactly where Form 1041 comes in. Form 1041 is the U.S. income tax return for estates and trusts. Remember, the estate is a separate legal and taxable entity from the moment of death until it's officially closed and all assets are distributed.
So the estate itself pays income tax.
It can, yes. Any income the estate's assets generate during administration, rent, interest, dividends, capital gains if assets are sold, is reported on Form 1041.
And is this filed just once or every year?
Form 1041 is an annual return. It needs to be filed for each tax year the estate exists and meets the filing requirements.
How long does an estate typically stay open?
It varies widely. Many simple estates are wrapped up within 12 to 18 months. But complex estates, perhaps involving businesses, litigation, or hard-to-sell assets, can sometimes remain open and be required to file Form 1041 for several years.
When is Form 1041 due?
Generally, it's due by the 15th day of the 4th month after the end of the estate's tax year. Most estates use a calendar year, ending December 31st, so the due date is typically April 15th.
Can you get an extension?
Yes, you can get an automatic 5.5-month extension for Form 1041 by filing Form 7004. That pushes the deadline to September 30th for calendar year filers.
Does every estate need to file Form 1041?
Not necessarily. An estate must file Form 1041 if it has gross income of $600 or more for the tax year. Or, interestingly, it must file if it has any taxable income and one of its beneficiaries is a non-resident alien.
Okay, $600 gross income threshold, or having a non-resident alien beneficiary. And if the estate distributes income out to beneficiaries?
Then the estate typically gets a deduction for that distributed income. We'll touch on D&I later. And the income becomes taxable to the beneficiaries. The estate issues a Schedule K-1 to each beneficiary, reporting their share of the income they need to include on their own, Form 1040.
Okay, so 1040 for income before death, 1041 for the estate's income after death. Now, the big one people think about. Form 706, the United States Estate Tax Return.
Right, Form 706. And it's crucial to understand this is completely different from the income tax returns. Form 706 is not an income tax return.
What is it then?
It's filed generally only once per estate. Its purpose is to report the total value of all the assets the decedent owned or controlled at the time of their death, what's called the gross estate. Then you subtract certain allowable deductions to arrive at the taxable estate. And finally, you calculate the estate tax, if any, that might be due.
And the most important point here for most people is that this form is only required if the estate is very large, right?
Exactly. Form 706 is only required to be filed if the decedent's gross estate value exceeds the applicable federal estate tax exclusion amount for the year of death.
And that exclusion amount for 2024 is?
For someone dying in 2024, that basic exclusion amount is $13.61 million.
Yes. So if the total value of everything the person owned at death is less than $13.61 million, a Form 706 is generally not required to be filed for the purpose of calculating or paying estate tax. We'll talk about why you might file it anyway later for portability.
Okay. But if the estate is over that $13.61 million threshold, when is Form 706 due?
It's due 9 months after the date of death.
9 months? That's not a lot of time to value everything.
It's not, especially for complex estates. However, you can get an automatic 6-month extension to file Form 706 by submitting Form 47768 by the original 9-month deadline. This gives you a total of 15 months from the date of death.
And the executor is responsible for getting this done and paying any tax before distributing assets. Absolutely. The personal representative has the duty to determine the estate tax liability, file the return if required, and pay any tax due, usually from the estate's assets, before making final distributions to the beneficiaries.
What about the fees paid to the executor for doing all this work? Are those taxable?
Yes, any fees paid to the executor or personal representative for their services are considered taxable income to them.
How do they report it?
It depends. If it's, say, a family member or friend who isn't in the business of being an executor, they typically report the fees as other income on their personal Form 1040.
Okay.
However, if the executor is a professional, like an attorney or an accountant, whose regular trade or business includes serving as an executor, then those fees are generally considered self-employment income and reported on Schedule C of their Form 1040.
Got it. Now, about liability. Can the executor be held personally responsible if the estate owes taxes but doesn't have enough money?
That's a common concern. The tax liability primarily attaches to the assets of the estate, so the taxes are paid from estate funds first.
But can the executor get stuck with the bill?
An executor can be held personally liable for unpaid estate taxes, but generally only up to the value of the estate assets they distributed before paying the taxes. If they follow the proper procedures, pay debts and taxes first, then distribute to beneficiaries, they usually aren't personally liable.
So if they distribute everything to the kids and then realize there's a tax bill, they could be on the hook personally.
Potentially, yes, up to the value they distributed. However, an executor is not personally liable if the estate is simply insolvent, meaning its debts and taxes exceed its assets, and there just wasn't enough money to pay everything, assuming they manage things correctly.
Okay, that makes sense. Pay taxes first. Let's go back to that $13.61 million threshold for filing Form 706. You said that's based on the gross estate. What exactly is included in the gross estate?
The gross estate is the fair market value, generally on the date of death, of all property the decedent owned or had certain interests in. It's very broad.
Like what?
Obvious things like real estate, bank accounts, stocks, bonds, mutual funds, cars, personal belongings. But also less obvious things like proceeds from life insurance policies owned by the decedent or payable to their estate, certain types of annuities or survivor benefits, even certain property the decedent transferred within 3 years before death if they retained certain rights or the transfer involved life insurance. Wow. So it's more than just what's in their bank account, what's generally not included. Things the decedent didn't own or control. For example, property owned solely by their spouse or someone else, or lifetime gifts they made where they completely relinquish ownership and control well before death.
But the sources mention the IRS can sometimes claw back gifts made shortly before death?
Yes, particularly if they were large gifts, potentially subject to gift tax, but no gift tax return. Form 709 was filed. The IRS wants to ensure the value is properly accounted for, either as a lifetime gift that used up some exclusion, or potentially back in the estate if the transfer wasn't truly complete, or falls under specific rules, like the 3-year rule for certain assets.
Okay, so the gross estate is the starting point. Then you take deductions to get the taxable estate.
Correct. The taxable estate is the gross estate minus allowable deductions. That's the amount the estate tax is actually calculated on, after considering the exclusion amount.
What are some of the main deductions you can subtract from the gross estate?
The key ones include funeral expenses, but only those actually paid out of the estate funds. Certain estate administration expenses like executor fees, attorney fees, appraisal costs, if they are not, also claimed as a deduction on the estate's income tax return, Form 1041. You have to choose one or the other.
Okay, can't double dip.
Right. Also, debts the decedent owed at the time of death, mortgages on estate property, the charitable deduction for amounts left to qualifying charities, a deduction for any state death taxes paid, though fewer states have these now, and a very significant one, the marital deduction.
Ah, the marital deduction. We hear about that a lot. That allows unlimited transfers between spouses tax-free.
Yes, that's the power of the marital deduction. It allows an unlimited amount of property to be transferred from one spouse to the other, either during life, as a gift, or at death, as an inheritance, completely free of federal gift or state tax.
But there's a big condition, right? The receiving spouse has to be.
The receiving spouse must be a U.S. citizen for the unlimited marital deduction to apply. The assets also generally need to pass outright to the spouse or into a specific type of trust that qualifies. If the surviving spouse is not a U.S. citizen, the unlimited marital deduction is generally not available, although there are some special rules involving qualified domestic trusts, QDOTs, that can sometimes help, but that's more complex.
Okay, so U.S. citizen spouse is key for the unlimited marital deduction, and this deduction is different from that DSUE thing you mentioned.
Correct. They sound related, but they're distinct concepts. The marital deduction is about the property passing tax-free between spouses. The DSUE, deceased spousal unused exclusion, is about the exclusion amount itself, that $13.61 million.
Okay, let's talk about DSUE and portability. This sounds really important for married couples.
It is incredibly important, especially for couples whose combined wealth might exceed one person's exclusion amount, but not necessarily double that amount. DSUE stands for Deceased Spousal Unused Exclusion Amount. It's simply the portion of the estate tax basic exclusion amount, $13.61 since in 2024, that the first spouse to die didn't need to use to shelter their own estate from tax.
So if the first spouse only had, say, $3 million in assets, they didn't use about $10.6 million of their exclusion.
Exactly. That $10.6 million, approximately, based on the 2024 number, is their DSUE amount.
And portability means the surviving spouse can.
Portability is the ability for the surviving U.S. citizen spouse to take that unused DSUE amount from the first spouse and add it to their own basic exclusion amount.
So in that example, the surviving spouse would have their own $13.61 million plus the $10.6 million DSUE from their deceased spouse.
Correct, giving them a much larger total exclusion amount, over $24 million in that scenario,
Yeah.
available to shelter gifts they make during life or assets they leave at their own death.
That's huge. But here's the source's stress. Portability is not automatic.
Absolutely not automatic. This is probably the single most critical takeaway about DSUE for married couples and their advisors. You have to elect portability.
How'd you make that election?
The executor of the estate of the first spouse to die must make the portability election
How do they do that?
by filing a complete and timely federal estate tax return, Form 706, for the deceased spouse's estate. And here's the kicker that surprises many people. They must file Form 706 to elect portability, even if the deceased spouse's estate is well below the normal $13.61 million filing threshold and owes zero estate tax.
Wait, so even if my spouse passes away and their total assets are only, say, $2 million, nowhere near the $13 million threshold, I still need the executor to file that big Form 706 just to capture their unused exclusion for me?
Yes. If you, as the surviving U.S. citizen spouse, want the option to use your deceased spouse's DSUE amount later on, filing that Form 706 for their estate is mandatory to make the election. The sole purpose of filing in that situation is often just to elect portability.
Wow. And what's the deadline for filing that Form 706 just to elect portability?
It's the same deadline as if estate tax were due, 9 months after the date of the first spouse's death, plus that available 6-month extension. So 15 months total if the extension is filed. There are some provisions for late elections in certain circumstances, but meeting the original deadline is always best.
And just to confirm, DSUE portability, like the marital deduction, is only available if the surviving spouse is a U.S. citizen.
Correct. A surviving spouse who is not a U.S. citizen cannot take advantage of the DSUE portability rules.
Okay, that is a massive planning point. File Form 706 even for smaller estates if you want to preserve that DSUE. Huge takeaway. Let's talk about a different kind of income related to death. Income in respect of a decedent, or IRD. What is that?
IRD, income in respect of a decedent. This refers to amounts of gross income that the person had earned or was entitled to receive, but which hadn't actually been paid to them by the time they died.
Like their final paycheck, or maybe interest that had accrued but wasn't paid yet?
Exactly. That final paycheck is a classic example. Unpaid salary or bonuses, accrued interest or dividends that were declared but not yet paid, payments for work the decedent completed if they were self-employed but hadn't billed or collected yet, accounts receivable. Even distributions from retirement accounts they might have requested but didn't receive before passing.
Okay, so where does this IRD get reported for income tax purposes, not on their final 1040?
Crucially, no. IRD is not included as income on the decedent's final Form 1040.
So who pays the income tax on it?
It's reported on the income tax return of whoever actually receives the IRD payment. That could be the estate itself, reported on Form 1041, or it could be a surviving joint owner, like on a joint bank account that received accrued interest, or it could be a specific beneficiary who was designated to receive that particular income item, like a beneficiary of an IRA.
And does the income keep its original character? Like if it was wages, is it taxed as wages to the recipient?
Yes, IRD generally retains the same tax character it would have had in the hands of the decedent. If it was salary, it's ordinary income. If it was a qualified dividend, it's taxed as a qualified dividend to the recipient. If it was proceeds from selling a capital asset before death, but payment wasn't received, it's capital gain.
The source has mentioned a detail about wages paid as IRD.
Ah, yes. Wages paid as IRD after the calendar year of the decedent's death are generally not subject to federal income tax withholding, although Social Security and Medicare taxes might still apply depending on when they were earned.
And what about self-employment income as IRD, like those accounts receivable?
Right. Accounts receivable for services rendered by a self-employed decedent are IRD, reported as ordinary income by the recipient. But the sources note they are specifically not subject to self-employment tax when received as IRD. However, a deceased partner's share of partnership income is generally included for SE tax purposes through the end of the month of death.
It's a bit nuanced.
Okay. Now, here's where IRD gets potentially complicated. It might be subject to both estate tax and income tax.
That's the potential double whammy people talk about with IRD. Because the right to receive that future income is considered an asset owned by the decedent at death. The value of that future IRD payment is included in the decedent's gross estate for calculating potential estate tax on Form 706.
So it could be taxed as part of the estate?
Yes. especially for larger estates exceeding the exclusion amount.
And then the person who actually receives the money later pays income tax on it too.
Yes. When the IRD is actually received, the recipient includes it in their gross income for that year.
That sounds like double taxation. Is there any relief? Yes. Thankfully, there is some relief. The tax code allows the person who receives the IRD and pays income tax on it to claim an itemized deduction on their own income tax return, Schedule A.
A deduction for what?
For the amount of federal estate tax that was attributable to that specific item of IRD being included in the gross estate. It's often called the IRD deduction or Section 691C deduction. It helps offset the income tax burden by giving credit for the estate tax already paid on that same value.
And that deduction is still available. It wasn't eliminated by recent tax changes.
Correct. The sources confirm this itemized deduction for estate tax paid on IRD was not suspended or eliminated by the Tax Cuts and Jobs Act. It's still available.
Good to know there's a mechanism, even if it's complicated. Okay, briefly, what about the net investment income tax, NIIT? Can that apply to estates?
Yes, estates and certain types of trusts can be subject to the 3.8% net investment income tax. It applies to the lesser of their undistributed net investment income, or the amount by which their adjusted gross income exceeds the threshold for the highest income tax bracket for estates.
How is it reported?
On Form 8960, which is filed along with the Form 1041, it generally doesn't apply to simple trusts, tax-exempt trusts, or grantor trusts.
Okay. And one more technical term from the estate income tax world. Distributable net income, or DNI. What's the concept there?
DNI is a key concept for understanding how estates and trusts are taxed on their income. Think of them as sort of hybrid pass-through entities. Income they earn can either be taxed to the estate on Form 1041, or it can be taxed to the beneficiaries if it's distributed out to them. It's generally not taxed at both levels.
So DNI helps figure out who pays the tax.
Essentially, yes. DNI sets a ceiling on the amount of income that the estate can deduct for distributions made to beneficiaries. And it also determines the maximum amount of the distribution that the beneficiaries have to include in their own taxable income. It's the mechanism that ensures the income is taxed only once, either to the estate if retained or to the beneficiary if distributed. The estate gets an income distribution deduction for the amount passed out up to the DNI limit.
Okay, prevents double taxation on distributed income. Let's shift to the perspective of the beneficiary. What happens when someone actually inherits assets? If you inherit cash, is that taxable income to you?
Generally, no. For federal income tax purposes, inheriting cash or property from a U.S. estate is usually not considered taxable income to the beneficiary. You don't report it on your Form 1040.
So if your grandma leaves you $50,000 in her will, you just receive the $50,000 tax-free.
From an income tax perspective, generally yes. Now, the beneficiary could potentially be responsible if the estate tax wasn't paid by the estate before distribution, but the inheritance itself isn't income.
And no reporting required by the beneficiary for a cash inheritance from a U.S. estate.
Correct. No reporting needed on your income tax return. The only exception we discussed earlier is if the inheritance comes from a foreign estate. If that exceeds $100,000, it could trigger that Form 3520 information reporting requirement for the U.S. beneficiary, but still typically not U.S. income tax on the inherited cash itself.
Okay. What about inheriting retirement accounts, like a traditional IRA or a 401k?
Those are treated differently because the money inside them usually hasn't been taxed yet. If you inherit a taxable retirement account, like a traditional IRA or 401k, any distributions you take out as a beneficiary are generally considered taxable income to you in the year you receive them.
Does the 10% early withdrawal penalty apply if the beneficiary is young?
No. That's the good news. The 10% early withdrawal penalty typically does not apply to distributions taken by a beneficiary from an inherited retirement account, regardless of the beneficiary's age.
What about inherited Roth IRAs or non-deductible IRA contributions?
If you inherit a Roth IRA, qualified distributions are generally tax-free to the beneficiary, just as they would have been to the original owner. And if you inherit a traditional IRA that contains non-deductible contributions, that portion can generally be received tax-free as a return of basis.
And surviving spouses have special options.
Yes. Surviving spouses often have the unique option to treat an inherited IRA as their own IRA, often by rolling it over into their own existing IRA or establishing a new one. This can allow them to delay required distributions and continue tax-deferred growth based on their own age and life expectancy, which can be very advantageous. Other beneficiaries generally have stricter rules about how quickly they must take distributions.
Okay, now this brings us to a really, really critical concept. When you inherit property, things like stocks, bonds, real estate, what is the tax basis of that inherited property?
This is absolutely crucial. The basis is what you use to determine your gain or loss if you later sell the inherited asset. The general rule, and it's a very favorable one, is that the basis of property you inherit from a decedent is its fair market value, FMV, on the date of the decedent's death.
So not what the person originally paid for it.
No, generally not. It gets stepped up or sometimes stepped down with the value decreased to the value as of the date of death.
That's the famous step up in basis.
That's it. It means that all the appreciation that happened during the decedent's lifetime is generally wiped out for income tax purposes for the beneficiary. If you inherit stock worth $100,000 on the date of death, your basis is $100,000. If you sell it the next day for $100,000, you have no capital gain.
That's a huge benefit. Is there any alternative to the date of death value?
Yes, there is an option called the alternative valuation date, AVD. But it's only available if the estate was large enough to be required to file a federal estate tax return, Form 706.
Okay, only if Form 706 is filed. What is the AVD?
The executor can elect to value the estate assets as of 6 months after the date of death, instead of the date of death.
Why would they do that?
They can only make this election if doing so results in both a lower total value for the gross estate and a lower total estate tax liability. It was designed as relief for estates where asset values drop significantly shortly after death.
And if the AVD is elected, that becomes the basis for the beneficiaries.
Yes, the FMV on the date 6 months after death becomes the basis. However, there's a wrinkle. If any asset is distributed or sold by the estate before that 6-month AVD, then the basis for that specific asset is its FMV on the date it was distributed or sold.
Okay, complicated, but date of death value is the main rule. The sources also mention a special use valuation.
Yes, briefly. That's a very specific election for a certain qualified farm or closely held business real property. It allows valuing the property based on its actual use, for e.g. farming, rather than its highest and best use, for e.g. development, potentially reducing the estate tax value. But it comes with strict requirements and recapture rules if the property stops being used for that purpose. It's quite specialized.
Got it. So step up to date of death, FMV, is the key basis rule for most inherited assets. Huge implications for capital gains later. Okay, let's shift to the final piece, gift tax basic.
All right, the gift tax. As we said, this applies to transfers of property you make to someone else while you are alive.
I mean, the tax is on the giver, not the receiver.
Correct. The federal gift tax is imposed on the donor, the person making the gift, not the recipient, the den. Like the estate tax, it's a transfer tax, not an income tax.
And it's tied into the estate tax how?
Through that unified lifetime exclusion amount, the $13.61 million for 2024. Any taxable gifts you make during your life, above certain annual limits, use up part of this unified credit, reducing the amount available to shelter your assets from estate tax when you die.
And the recipient of the gift, they generally don't owe tax or report it.
Generally, no. The recipient of a gift typically owes no federal income tax on the value of the gift received and has no obligation to report it on their U.S. tax return.
Unless, that exception we keep mentioning.
Unless it's a gift from a foreign person exceeding $100,000 in a year, which triggers that Form 3D-520 information return filing for the U.S. recipient. But still, usually no income tax on the gift itself.
Okay. What are the key limits and exclusions that let people make gifts without triggering gift tax or using up that lifetime exclusion?
The most important and widely used one is the annual exclusion.
How much is that now?
For 2024, the gift tax annual exclusion amount is $18,000 per recipient per year.
$18,000.
Yes, this means you can give up to $18,000 in cash or property value to any number of different individuals each year. And those gifts are completely free of gift tax. They don't use up any of your $13.61 million lifetime exclusion, and you generally don't even need to file a gift tax return, Form 709, to report them.
So I could give $18,000 to my son, $18,000 to my daughter, $18,000 to my neighbor, all in the same year, no problem.
Exactly. No gift tax consequences, no lifetime exclusion used, no Form 709 needed for those gifts, assuming they're present interest gifts, which most simple gifts are.
Okay, $18,000 annual exclusion per person. Then there's the big one, the lifetime exclusion.
Yes. That's the $13.61 million for 2024. It's indexed for inflation, so it changes. This is the total amount you can give away above and beyond the annual exclusion amounts over the course of your entire life before you actually have to pay any gift tax out of pocket.
So if I give someone $50,000 this year, the first $18,000 is covered by the annual exclusion. And the remaining $32,000 uses up a chunk of my $13.61 million lifetime exclusion.
Precisely. You'd need to file a gift tax return, Form 709, to report that $32,000 taxable gift and track its use against your lifetime exclusion. No tax would likely be due yet, assuming you haven't used up your full $13.61 million, but you have to report it.
And the maximum gift tax rate, if you ever exceed the lifetime exclusion, is...
It's the same as the top state tax rate, currently 40%.
Okay. So when exactly does someone need to file Form 709, the U.S. gift tax return?
You generally must file Form 709 for any year in which you make a gift to any single person that exceeds the annual exclusion amount, $18,000 for 2024.
Unless it's to your spouse.
Correct. Gifts to your U.S. citizen spouse are generally unlimited and don't require Form 709 thanks to the marital deduction, but gifts over $18,000 to anyone else, kids, grandkids, friends, require filing Form 709.
Are there other reasons to file Form 709 besides exceeding the annual exclusion?
Yes. You also need to file Form 709 if you want to elect gift splitting with your spouse. We'll talk about that. And you generally must file it if you make a gift of a future interest, regardless of the value.
Okay, future interest gifts always require filing. What's the difference between a present interest and a future interest gift?
A present interest gift is one where the recipient, the donor, has an immediate, unrestricted right to use, possess, or enjoy the property or the income from it. Think of giving cash or stock they can sell immediately. These qualify for the $18,000 annual exclusion.
And a future interest?
A future interest gift is one where the recipient's right to use or enjoy the property is delayed until some point in the future, or is contingent on some future event. A common example is contributing money to certain types of trusts, where the beneficiary can't access the funds until they reach a certain age.
And those future interest gifts don't qualify for the annual exclusion.
Correct. Gifts of future interest do not qualify for the $18,000 annual exclusion. You have to file Form 709 to report them and use up part of your lifetime exclusion, even if the gift amount is small.
Okay. You also mentioned filing Form 709 for gift splitting. What is that?
Gift splitting is a technique available to married couples. It allows them to elect to treat any gift made by just one spouse to a third party, like a child, as if it were made one half by each spouse.
What's the benefit of doing that?
The big benefit is it allows them to combine their annual exclusions for that recipient. So in 2024, a married couple splitting gifts could give up to $36,000, $18,000 from each spouse, to a single person without using any of their lifetime exclusions.
So one spouse writes a $36,000 check, but they elect to split it.
Exactly. If they both consent to gift splitting for that year, which requires filing Form 709, that $36,000 gift is treated as $18,000 from each of them, fully covered by the respective annual exclusions. It also allows them to potentially use both of their lifetime exclusions if the gift exceeds $36,000.
Do both spouses have to agree?
Yes, both spouses must consent to gift splitting for all gifts made by either of them to third parties during the calendar year. They signify consent on the Form 709. A quick note. If the gift is made using community property funds, it's often automatically considered made half by each spouse without needing a formal split election.
Okay, gift splitting doubles the annual exclusion power. Are there other types of gifts that are just completely exempt? They don't count against the annual or lifetime limits and don't require filing Form 709.
Yes, there are several important categories of non-reportable, non-taxable gifts.
Like?
Gifts that are within the annual exclusion amount, $18,000 per person in 2024. Direct payments you make to an educational institution for someone else's qualified tuition.
Directly to the school.
Yes, payment must go directly to the school. Similarly, direct payments you make to a medical provider for someone else's qualified medical expenses.
Directly to the doctor or hospital.
Correct. Unlimited gifts you make to your U.S. citizen spouse. Gifts made to qualifying charitable organizations. Gifts made to certain political organizations. And generally financial support a parent provides for their minor child, as that's usually considered fulfilling a legal support obligation, not a gift.
Okay, so direct payments for tuition and medical are a big exclusion, separate from the $18,000. Good to know.
Very useful exclusions, yes.
And just to tie it all together, that $13.61 million lifetime exclusion, it covers both gifts made during life, above the annual exclusion, and assets passed at death. It's one unified amount.
Exactly. It's a unified credit against gift and estate taxes. The total amount you can transfer tax-free, whether during life or at death, is currently $13.61 million, plus any DSU you inherited. Using it for lifetime gifts reduces the amount remaining to shield your estate at death.
Wow. Okay, she have covered a tremendous amount of ground here. From those, potentially forgotten foreign bank accounts, all the way through navigating the really complex world of U.S. estates, inheritances, and gifts. So let's bring it back. What does all this really mean for you, the listener? Why should you care about all these forms and thresholds?
Well, I think it means that certain, actually pretty common life events can suddenly pull you into this complex web. Things like just having a foreign bank account, maybe from studying or working abroad years ago, receiving a large gift, especially if it's from someone overseas, inheriting assets, even from within the U.S., or being asked to step up and be the executor for a parent's or relative's estate.
Right. These aren't necessarily rare events, and they can trigger these rules, these reporting requirements, or even actual tax liabilities that are just really easy to overlook if you're not aware.
And as we've highlighted throughout, particularly with the foreign reporting side, the penalties for not complying,
Yeah.
even if it was completely unintentional, just not knowing, they can be incredibly severe, disproportionately so sometimes.
So understanding these rules isn't just about, ticking boxes for the IRS or avoiding penalties, though that's important. It feels more like it's about being proactive, responsible management of your own financial life.
Exactly. And being prepared for these potential roles or situations. It's about planning, awareness, and managing your financial affairs, and maybe the assets you might pass on or receive responsibly.
Okay, so just to quickly recap the two major territories we explored today. First, the U.S. reporting requirements for foreign accounts and assets. We hit the big forms. FBAR, Form 8938, that Schedule B checkbox. Form 3520 for foreign gifts, and Form 5471 for foreign corporations.
Right, focusing on thresholds, filing mechanics, and penalties.
And second, we navigated the landscape of U.S. estate and gift taxes, covering the different tax returns involved when someone passes away: the final 1040, the estate's 10041, and the estate tax form 706. We talked about those really significant exclusion amounts, that crucial concept of DSUE portability for married couples.
Very key point, portability. We also touched on income in respect of a decedent IRD, how inheritances are generally treated for income tax, that all-important step up in basis for inherited assets.
Yeah, basis is huge. And finally, the basics of gift tax, the annual exclusion, the lifetime exclusion, Form 709, and what kinds of gifts are exempt.
We definitely reinforce those key numbers to keep in mind. That $10,000 aggregate FBAR trigger, the $100,000 foreign gift reporting threshold on Form 3520, the very large $13.61 million unified estate and gift tax exclusion for 2024, and that handy $18,000 annual gift exclusion.
And the recurring theme: reporting obligations can exist even without taxable income being generated, and understanding the rules and filing deadlines is absolutely vital to avoid potentially serious consequences.
Couldn't say it better. Timeliness and awareness are key.
Well, thank you for providing the source material that allowed us to really take this deep dive today. It's certainly a rich, maybe sometimes dense, but really important area of the tax code.
My pleasure. It's complex stuff, so hopefully breaking it down helps make it a bit more accessible.
Absolutely. This whole deep dive really highlights how interconnected these seemingly separate parts of the tax world are: foreign accounts, gifts, inheritances, estate planning, and it shows how seriously the government takes transparency and enforcement across all of them.
That's true. They all tie together in ensuring wealth is tracked and taxed appropriately according to the rules.
Which brings us to a final thought, maybe something for you, the listener, to consider. We've covered a lot about the rules and the potential pitfalls, but think about this. Given the stakes involved, the complexity, and the potential for just accidentally messing up, how might taking a proactive approach to understanding your specific situation regarding these rules actually impact your financial planning right now?
Yeah, like maybe taking inventory. Do you have any foreign connections you haven't thought about recently? Have you discussed potential executor roles or inheritances with your family? How might knowing these rules influence decisions you make about saving, helping family, or just being prepared for those unexpected life events?
Exactly. It's not just about compliance after the fact. It's about how awareness now can shape your planning for the future. Keep exploring how these pieces might fit into your own financial picture.
Awareness really is the critical first step.
Yeah.
It empowers you to ask the right questions and seek the right advice when you need it.